Hello and welcome to the UK SIF Leadership Podcast. It's Sally here on day 8 of COP26 with James and Jason Mitchell. Today we'll be discussing adaptation and climate resilience. Jason is co-head of responsible investment at Man Group, and as I'm sure you're aware, the host of another podcast, which we'll give a shout out to. The Sustainable Future podcast is hosted by Jason. It's a monthly discussion with amazing speakers. He has a brilliant episode coming out soon. He'll be discussing macroeconomic policy and climate change with Emmanuel Munch, head of research at Bundesbank. So be sure to tune in to that.
Hello, it's James and Sally here to let you all know about our podcast sponsor.
This COP26 series of the UK SIF Leadership Podcast is sponsored by Lion Trust. We're delighted to have them involved. Lion Trust is a specialist fund management company that was founded in 1995.
And as of July 2021, they had £34 billion in assets under management. Their aim is to have a positive impact on their investors, stakeholders, and society.
We're so pleased to have them on board for this series. Without the support of our partners, the podcast would not be able to happen.
So, without further interruption, let's get on with the episode.
Thanks for joining us, Jason.
Perfect. No, thanks for the shout out. I always appreciate it.
So let's just dive straight into it. We'll start with the basic question. What is climate resilience?
It's such a big question that I've tried to kind of grapple in a lot of different ways, even on my own podcast, because there's so many different constructs around it. There's climate resilience. Like when you think about it, there's this transition mechanism in a policy perspective. I think best manifested, to be honest, over the last week or two from the UK government in their net zero strategy. And the point of that is to sort of transmit national level policy down to industry as well as investors, and to sort of send this sort of blueprint on how to decarbonize certain industries through think of electrification. We've made certain progress around that, electric vehicle charging, heat pump replacement, etc. I think there are a couple other constructs to think about as well in terms of what climate resilience is. And then, from a financial perspective, that can take different forms. I think in my mind, it's got to begin with disclosure. We've obviously seen a lot of different disclosure standards that have come out. Probably most prominently from the EU, the Sustainable Finance Disclosure Regulation, from the UK, the Sustainable Disclosure Regulation, and certainly the SEC is thinking about how to improve its disclosure standards, both at the corporate as well as the product level. So it's got to start at a disclosure level, and that should ideally lead on to some form of action. From an investor perspective, that can take a number of different forms. There are, I do think, some polarized views around what that means. Does it mean divestment? I think there are certain pros and certain cons to that. Does it mean engagement? I mean, frankly, this is a very controversial conversation going on right now. I would think that I would say that there's probably even some pros and cons to the engagement argument as well. But the point is that resilience at a financial level has to travel through a certain path. It has to, begin with this, at the point of sort of disclosing the level of call it, carbon or climate exposure, the risk exposure within a portfolio. It's got to travel through, the actions at a portfolio level, at a firm level, frankly, and ultimately, through engagements with companies.
Just to add to that, Jason, I think, I agree with you. And I think we need to, it's a lot of it's got to be about disclosure. I think there's also this other challenge though, particularly when we're talking about physical climate risk, where we're thinking about, Oh, okay. So our we don't have that physical climate risk because our factory is located high up, our office is on the third floor, whatever. But actually, how do we start measuring and understanding that kind of climate risk that is associated with fine, your factory might not flood, but none of your staff can get there for 3 weeks because the bridge has been washed away. How do we measure that bit in these disclosures and figure that out?
Yeah, I mean, it's a fantastic question. I mean, the whole idea of sort of physical risk and how you measure that. I think there are, and I sort of tip my hat to the industry. I've seen some pretty good analytics from the insurance industry that really delve into that. Frankly, they have to. I mean, so you look at a city that is climate aware, constrained, whatever you want to call it, Miami. When you look at the sort of the elevation, and so the sensitivity to sea level rise, there is a pretty sophisticated view from the insurance companies about what that costs. I think it's a bit more problematic in other areas, though, and frankly, I think it's all investors, including ourselves, sort of struggling on this. And I think the bigger question is, what do you do about data, particularly in the context of a requirement around greater disclosure? And I think you have to think about it in call it a waterfall or kind of a cascading kind of perspective. And this is probably best manifested in the unlisted, I would even say kind of credit area, where, look, the best solution is to go out and find company specific data that is collected from third-party data providers, so effectively verified. The next best alternative is to go out and collect that information yourselves. So, PE funds, private investors are sort of ideal in that situation. If you can't do that, then you kind of, it's sort of, you run into this problematic situation of how do you represent the data for the rest of your portfolio? And I think, you've got to make some questions. And I think you have to make very distinct disclosures to investors about what is, quote, modeled and what is not. I.e., if you don't have company specific data, to what degree do you use sectoral proxies, which unfortunately mean that for that portion of your portfolio, you might be overlooking certain tail risk elements to it. Does that make sense?
I think that makes a lot of sense. Do you think financial services is doing enough on this? And do you think that they understand how much this should matter?
I think they do. I think there's this real interesting point of soul searching for finance right now. I think the Tarek Fancy, the former CIO of sustainability within BlackRock, has sort of ignited this or sort of activated this. But there's this sort of question of what role does finance play in this landscape, and what should it play, frankly, relative to other levers, in particular the regulatory element. The fact is that I don't think anyone believes that finance should sort of lay passive and let regulation dictate the course. I think when it comes to ESG or sustainable investing, to finance's credit, and there are a lot of single, kind of points to recognize, UCSIF is certainly one of them, PRI, share action. I think over the last 10 to 15 years, you've had this phenomenal reorganization of finance, which prior to that has been atomistic. It's been fairly unorganized, but you've had this organizational power from a lot of different initiatives or organizations that have cohered finance around reporting in some ways, certainly around certain the integration of certain norms, exclusions, for instance. It might be around stewardship, absolutely, and I think that has elevated finance in a way that, and I've been in finance, more than almost about 25 years now, but in a way that I've never seen sort of previously. So I think as an actor at an aggregate level, finance is playing a role that it has never sort of played over the last, several decades. But I think it's important to note that has to run parallel with progressive, strong regulation. Look, people might disagree with me. I as powerful, I think, as finance plays in the economy, I don't think it's the predominant driver in sustainable finance. It has to be regulation. It has to be particularly legislative efforts.
That's 100% the UK CIF view. I think there's a large group of people that think that, well, financial services alone can fix all these problems, and no one else needs to make any hard decisions because the market will make it all work. That is just patently not the case. And I think that unfortunately for government, who don't like making hard decisions because they're democratically elected, sadly they're going to have to do hard stuff. We have. If you look at the size and the scale of the levers that people can pull, we have, you mentioned stewardship earlier. We have stewardship, we have divestment, we have a few other things. I personally prefer us to do a bit more stewardship. These are some of the levers that we have as an industry. Of course, lending is a different question as well. What we lend into shapes things and makes things happen. But we don't ban things. We can't stop things from happening. We can make things happen. We can't necessarily stop things from happening. And I think that's where government actually has a key role. And government can stop things from happening. It can tax things into oblivion. But it can also make things happen and shape the direction of industry. We were quite pleased to see the UK government put out its green, its kind of net zero roadmap last week. The reason why is because finally it starts putting some meat on the bones of what our lives will look like in a net zero world that we hadn't seen from government before. And so as investors, we're still saying, well, we're just feeling around in the dark thinking, well, we have a vague idea of what net zero might look like, so let's try and invest in some of those broad areas. But actually, now that we've got government saying, yes, we're going for it, this is what it's going to look like, this is how our lives are going to be lived, we can as investors start to focus on some of the investments that are going to enable those frameworks to happen. And I think that's a really important piece that you raised.
Yeah, it's so interesting because in some ways, we're watching this sort of manifest right now. Over the last 18 to 24 months, obviously the SFDR out of the European Union has sort of come about. Within the UK. Like you said, we have the net zero strategy, we have the SDR, the sustainable disclosure regulation, really strong progressive forms. In some way, in a number of ways, the UK SDR goes far beyond the SFDR. It's, I think, quite interesting that in Anglo-Saxon kind of perspective would sort of take an active view around particularly steering capital in a way that it hasn't before towards sustainable sectors. I think, as comparison, and I'm obviously sort of American, although I've lived in London over the last 20 plus years. I think what's interesting from an American perspective is you lose that legislative underpinning, and it becomes this inter-electoral cycle problem. Frankly, you're playing electoral cycles through regulation. So look, it's fantastic if the SEC can come out and really lay out a progressive framework around corporate disclosure and product level investor disclosure. It's fantastic if they can do something about unwinding what the Trump administration had done around proxy voting. I think the fear is what's going to happen in 4 more years under the next administration if it flips. I think there's a lot of merit to the UK and the European view, which is to say, let's legislate this, let's play the long game, let's work this stuff out over periodic fitness tests and constantly improve it.
I think it helps in the UK. I think it helps that and actually Europe as well, that there is a broad political consensus that climate change is a problem that needs to be fixed.
Absolutely.
And sadly, unfortunately, the US is not yet in that space, and that is I think a really serious problem for US politics. Although my understanding is that if you look at the last election and when Biden won, my reflection of that election on his climate policy was he got stronger and stronger and stronger in what he was saying on climate change, which never happens. Normally you go really strong to win the primary nomination, and then you kind of pull back on a whole lot of the more controversial stuff. Nobody gets stronger on things that are controversial, and so it must be that it was polling really well. And I read a few articles that showed just that it was polling, and actually Trump was losing votes by not embracing climate change in any way in his policy. So maybe that is the starting point of this turning, but I don't know whether the Republicans are going to pick that up or not.
I agree. Well, I mean, one of the most disheartening things, I was sort of looking back recently about all the stuff I've written about this and published, and I'd written about, efforts more than 10 years ago to sort of push through a cap and trade program. Recently you had the Baker-Schultz plan, which is this bipartisan plan that would drive a kind of a carbon dividend, but effectively you get a carbon pricing mechanism within the U.S. I think what is disheartening about it is, since that debuted, both Baker and Schultz have sadly passed away, and you don't really have that kind of consensus to push forward something. So now, in the context of COP26, where are we when it comes to Article 6, which is that last feature within the Paris Accord that remains unfulfilled? How do you kind of create an international carbon pricing regime that is, potentially not necessarily governed by the United Nations? The U.S., frankly, is the sticking point. It's not necessarily, emerging, markets, emerging countries, developing countries, which were the kind of the blocking issue 5 to 10 years ago.
Do you mind if we take a side tangent, Sally? I feel like I'm taking over your podcast.
That's okay. I'll let you go on a little tangent.
I'd want to come back to that kind of carbon pricing thing, because I, strongly think that that's one of the really key areas that governments can take action. But the side tangent I want to take links back to you mentioned Tariq Fancy from formerly BlackRock, and people may know that he published an enormous essay talking about his disillusionment with ESG and ESG investing, and it used basketball metaphors throughout, which fundamentally were saying, the theory of ESG investing is that by being good off the pitch, you may score more points on the pitch, was the fundamentals. Is it a basketball? No, it's a basketball court. Sorry. But anyway, the point, I guess that was the metaphor. And I guess I'm really, Jason, really keen on your thoughts on this, and whether he was right, whether he's saying right. I'm dubious about whether he's right, because I think what he forgot to include, and maybe this is a US perspective, so maybe this isn't actually so much of a tangent from our previous conversation, is that he forgot to include the policy risk, because to me it feels like certainly in the UK and Europe that there is a huge policy risk from not following through and not being active on climate in particular, and as well as other ESG issues. That to me is something that he just missed out. Have I got that wrong? Did I miss?
No. I 100% agree with you. I mean, so I've got two misgivings when it comes to Tariq Fancy's work. Although I do think that it was incredibly articulate. It adds to the discourse and debate, which we need to have. It animates it in a way that I think more constructive criticism needs to. So first, look, we've got to take this into context, and I think we have to distinguish between the DWS incident, where Fixler is a legitimate whistleblower. Tariq Fancy sort of labels himself as a whistleblower. Look, I'll be completely honest. I don't think he is, a whistleblower in the same sense as Fixler for DWS. I think he's calling out the industry rather than firms. So I think we have to kind of calibrate how we think about his criticism slightly differently. Secondly, I completely agree with you from a policy perspective. And I do think that I think he might be calibrated a little bit more to the U.S. Sort of situation, where, as we were just talking about, we're kind of finding ESG play out from an SEC perspective, in particular, across the views of the 5 SEC commissioners, in a dynamic way, right? I mean, they are effectively debating the fundamental building blocks of ESG in terms of materiality, in terms of disclosure, and in terms of like how to enforce this in a way that the EU has already deliberated over many, many years ago, and rather is just, instead sort of figuring out how to operationalize. And same with the UK as well. So I think that's important because, as UK or European investors, we are just attuned to different parts of the arguments. Can you guys hear the piano as well? Okay. Yeah, there's so my partner's down there playing with my son on the piano. So maybe I just hear it. Okay.
You're probably more finely attuned to it.
James, did that make sense, or did you want me to elaborate?
No, that's absolutely brilliant.
Okay.
No, thank you. I might just follow on that a little bit, but
sure.
Jason, that's brilliant. I think you're absolutely right. He has made a really, really important contribution to the debate, and I think what he highlights if people in his sort of position are feeling disillusioned by this industry, there's something really serious that we need to do to address that. But I think it perhaps does also reflect that maybe the US really, really needs to do so much more. We think maybe that we had 4 lost years, and in that time, everyone else, the whole world, like the rest of the world, moved forward. But maybe there's a whole structural change that the US has just missed the boat on what has happened over here in Europe and the UK, and that we're just thinking about things so differently.
It certainly could be, because part of the way he characterized sustainable investing was, I've almost got to say was even nihilistic, sort of, in a sense. It was so critical and cynical in a way that wasn't constructive. And I feel like, within the continent or within the UK, it's a completely different conversation. It's how do we solve these problems? And there are, obviously problems, but how do we think about frameworks? How do we think about the right kind of policy? How do we think about calibrating certain elements within that? And acknowledging, there are a lot of interpretational problems within that. That's absolutely clear. But there's, and I think I've benefited from it. I think we all have, but just this active debate about how you solve for the low transition economy, in a way that doesn't really exist, I think, yet in the US, sadly, particularly, I would say on a legislative perspective and even on a policy / regulatory perspective, because it's still, frankly, early days.
So if we bring it back to sort of the investors, and what adaptation do investors have to make when looking at climate change? How do you effectively incorporate it into your portfolios? Is it easier for systematic funds?
Yeah. So we at Man Group are relatively recent. We weren't among the first wave 1 and wave 2 of net zero signatories. So we were in wave 3 of the net zero signatories. I'm a big proponent of that. I'm also cognizant of the fact that net zero is an incredibly complex process. All the answers aren't necessarily there, particularly when you're talking about firms with investment businesses and sort of the implications around scope 3 implications, how to treat, in particular, certain questions that, frankly, we actually, I think, do differ from IIGCC, the Institutional Investor Group on Climate Change's guidance. Some of those deal with how to treat mandates. Look, the fact is, if you're an investor, you've got legal contractual considerations that you've got to take account, in your fiduciary obligations, and meaning that you can't sort of just take all your AUM, assets under management, and sort of lump them into a net zero strategy. So I think it is necessarily a bit more nuanced in that perspective. I think there are a couple other areas that are problematic that we're working out with, and I do want to call out that while we do have some issues with IIGCC recommendations and guidance, I would recognize the fact that IIGCC has sort of created this very powerful, effective, you'd call it like an epistemic community of investors and policy thinkers that can get together and at least develop and refine some of this stuff. So, I mean, outside of mandates, the other one would be how to treat non-corporate issuers. So this goes back to the ESG data question. We've got increasingly better, richer data around corporate issuers, both in the fixed income and obviously the equity space. But how do you treat other areas? We do have, emissions data for sovereigns. I think the trick, though, is how to think about that on a forward-looking basis, which gets a little bit trickier. It goes back to Mark Carney's horizons problem. How do you kind of push forward this data in a credible way? Which has been, I think, problematic for a lot of us in terms of how to model that on a company specific, not necessarily sector specific way. And the other area is, I would say, two other areas, in fact. One, the use of offsets, incredibly controversial. And so, it's something that I'm very open to kind of hearing all arguments about. Offsets have certainly gotten a negative reputation over the last 10 to 15 years, given that they are avoidance related, and there's been a lot of controversy around the use of them. I think what's interesting from my perspective is that all the policy signals I get from policymakers, and those include, even on my podcast, the acting chair of the U.S. Commodities Futures Trading Commission, CFTC. It's the sister regulator to the SEC, as well as to Elizabeth Mrema, who is the executive secretary for the Convention on Biological Diversity. That's a UN organization. But, they seem to be sending signals to say that we need, at least over the next 10 to 15 years, bigger, better, importantly, higher quality offset markets to drive this transition. And so I think I'm a bit more open than most. And I clearly recognize that we need to level up the quality of offsets. But I do think that there's a role in offsets in this transition in a way that I think many others seem to be rejecting them. And I think the last area, and it's become increasingly controversial for alternative funds, is this sort of idea of to what degree or what role does shorting play in the transition towards net zero. I think I've seen some of our peers and others talk very supportively about how shorting can support net zero. I would take the counterpoint, and I think we believe this as a firm, which is to say that, look, we're conflating a lot of things in this kind of argument, right? We've got to separate a few things. There's carbon accounting, which is sort of distinct from the impact on the real economy. And we want to keep those separately. So I would say that it's problematic if you use shorts to support your path towards net zero. Effectively, net zero is a project, despite the problematic problem of it being called net. Net being its gross emissions, netting your offsets. But those offsets should be, in a credible way, taking emissions out of the atmosphere, and those ultimately those emissions at the tail end should be your residual emissions that are very tough to mitigate. So that's where we kind of get to. I think, suddenly netting them against, some notional kind of short element that doesn't solve for taking emissions out of the atmosphere is changing the argument. I think it's sort of misportraying or mischaracterizing the argument in a way.
And how about physical risk and resilience? How do we pay for this transition?
It's going to be very difficult. So physical risk, we're working with a number of models, particularly on our systematic side, around physical and transition risk. And by the way, it is in some ways easier, in some ways a little bit more difficult from a systematic perspective. Just to go back and not to sort of divert from your question, but from a systematic perspective, I think, we're talking about rules-based strategies that can implement carbon constraints rather easily. I think there are other elements, particularly around engagement. They're obviously sort of more challenged by the nature of systematic strategies, given sort of their focus on breadth. So these models tend to be very good about understanding physical risks. From our own experience, kind of combining general climate models and sort of an analysis about where within the world you have the greater amounts of temperature spikes, and sort of the implications on economic productivity, and obviously some sort of second and third order implications around sea level rises and what that means for sort of infrastructure. To how will we pay for this? I think that's a very difficult question. Yeah, I'll be honest. I don't know how to answer that. I mean, I'll be completely honest. I'm not quite sure.
And to be honest, I think that also is what makes it why this is a topic at COP, because this is one of the key things that needs to be paid for. And that's why that's why we're also having this $100 billion plan, which of course we've not been able to meet at this COP, but why there is still the demand from developing countries for $100 billion a year of support. A lot of it is about, some of it's about decarbonizing, a lot of it is about resilience. And we used to think that, I guess, back 10 years ago or so, that we shouldn't focus on resilience or adaptation, because that was acknowledging that we'd failed to reduce emissions. But actually, I think now we're much more sophisticated approach. We're already at 1.2 degrees. We're seeing what is happening, and we're recognizing, sadly, the fact that the climate is going to change no matter what we do now. We've got to stop the emissions because that will only get worse. But we've also got to start protecting ourselves more. And it's not just in developing countries. We need a new Thames barrier in London. That's going to cost billions and billions of pounds. We've got to figure out this. And to be honest, it concerns me that we talk a lot about infrastructure when it comes to climate change, but we think very little about how we're actually going to pay for infrastructure. Whether it's the kind of emissions reducing infrastructure like electric vehicle charging points, they need to be everywhere. Where's the through to obviously all the new heat systems that need to be installed in every building in the world, through of course to the stormwater drainage systems, the sea defenses. All of this is going to cost so much money. But and I think I still feel that the infrastructure is the missing piece of the climate finance conversation right now. We talk a lot about investment, we talk a lot about lending, we talk a lot about stopping funds to fossil fuels, and this is all really, really super important. But where's the funds, the positive infrastructure now?
Yeah, I think where I sort of pause and where I kind of really struggle around this answer is, the fact that and this came up around a question with Chris Stark in one of my podcasts. He's the CEO of the Climate Change Committee, who's the independent and statutory body that governs the UK government's net zero strategy. But it's sort of this question of coming out of the pandemic, particularly with the fiscal support through the pandemic. There's some clear fatigue. And this is probably best kind of exemplified in the US, where you have a lot of pushback by Republicans around continued fiscal support during the pandemic. But you sort of have this balance of like, to what degree, following the fatigue around this fiscal support during the pandemic, how does that sort of sensitize the argument around funding for climate change? I really worry about that. Look, frankly, we've already seen that within the UK, right? I mean, there's been sort of a pullback from 0.7% to 0.5% of UK budget funding for developing countries. So there's already been a cutback in terms of foreign aid. So I do worry that in some ways the pandemic has sort of come at the worst amount of time, and it's kind of numbed the ability and sort of willingness to fund climate resilience.
Yeah, I think you're absolutely right. I think on the other side, though, what it has done potentially to attitudes is shown us that we are much more vulnerable than we thought we were. I think we thought we ruled the whole world as a human race, and one little virus comes along and very quickly shows us that that's not true. I think what it's also done is it's shown that enormous changes to the way that we live our daily lives are possible quite quickly, and you can take the public with you. And so I think that there's some complex, are they positive lessons? I don't know, but there's certainly, we have found things out about our society that we didn't know before, both from how we manage society in terms of how we can, and the complex, the climate connection would be how we can manage this transition that is going to change the way people live their lives, but through to our vulnerability as well. And I think if we thought about all those things in advance, I'm sure there's lots of people saying, well, what if we did this before the pandemic? Well, yeah, we've got years of head start on climate change. We don't want the what ifs. We need to figure that out now. And that's where I think we've got the chance to really be pushing for this infrastructure to be developed.
Yeah, it is interesting because there is this. The lesson over the last 18 to 24 months is that systemic shocks are pretty profound to the global financial system and the world economy. I think what's been interesting even before that is, the CFTC, the Commodities Futures Trading Commission, had issued in late 2019 a really interesting paper talking about managing climate risk in the U.S. financial system. And I think they took pains in a way that I had not, I think, appreciated this nuance, but to sort of separate systemic shocks from subsystemic shocks. So this idea of like subsystemic, and I think when you think about climate change, there was a recent ECB paper, an occasional paper. They call it occasional. It was 200 pages long, called Climate Change and Monetary Policy. And so this is sort of my next podcast with Emmanuel Munch, who had co-chaired it, of the Bundesbank. But they really sort of delve into some of the implications on these subsystemic areas. The fact that parts of Southern Europe, these regional or more localized areas, are very vulnerable to rising sea levels, to wildfires, et cetera. And to what degree does that, how do you manage that risk in the context of the Euro system? Really, really interesting stuff.
Super interesting. I think the other thing we need to think through, I think, is realistically, how can public money support the capturing the private capital that's needed to make this happen. And so we're seeing in the UK the creation of the UK National Infrastructure Bank. It is on many sense round two, because we had a green investment bank before, which I think played quite a role in kickstarting the offshore wind industry. Now, the challenge for these sort of institutions is it's not you can't measure your success on deploying capital. You measure your success, in my mind, on how much private capital you crowd in and how much of a market you create. And so, to manage an institution like that is really hard, because as soon as you're successful, you have to say, right, we're being too successful in this area, private capital can come in and cover this now. We move on to the next hard thing, and we literally start from scratch, and we build up the business in the same way again until that's too successful, and then we move on again. That is a really hard institution to run, because the human nature says you do something that's successful and you keep doing it. But it's about crowding in that capital. Maybe that's where we need to start seeing some of these resilience investments.
Absolutely.
Thank you both. This has been a really great discussion. Thank you so much, Jason, for joining us. Thank you to the listener for tuning in, and remember to give Jason's a podcast a listen too. They have some really great discussions in this space. Big thank you to our sponsor, Lion Trust, for helping us to make this possible. Don't forget to like, subscribe, and tune in to our other episodes from throughout COP26. And you can find us on Twitter @UKSIF. Thanks.
Perfect. Thanks so much. Take care.